All right. Good afternoon, everybody. So excited for another Facebook Live where we bring you real estate tips. Today, we have an exciting topic that we're going to talk about that you don't want to miss. I'm telling you, this is one of the topics a lot of dentists in this group are longing to hear. And we've got the expert in the room who's going to cover that, who's done so many of these that he could just pick out numbers and stuff for the back of his hand. So today, we're going to talk about dental real estate, guys, how you can acquire your own place and put your practice there. My name is Tom Bibi Varghese. I'm the co host with Dr. Noah Liu. We run the group specifically for doctors and dentists. I'm an entrepreneur. I started in real estate about 4.5 years ago, acquired a lot of properties and partnerships in properties. And today I enjoy the passive income that comes from that. And here's my partner and good friend, Noah, Dr. Noah Liu. Take it away, brother.
All right, my man. Thanks so much. Hey, welcome everybody. Another episode of our Facebook Live. And today we're going to be bringing in a really cool topic, and it's about dental real estate. My name is Noah Liu. I'm a general practice dentist, and I'm based down in Peoria, Illinois. We own multiple practices. And with that being said, there are some perks about owning the dental real estate and having a portfolio. So about a couple of weeks ago, one of the members hit me up, and great guy, Dr. Sanjay, and him and his wife. They're looking at a practice, not their own practice, but looking at an investment opportunity. And so I was like, you know what? Let's try to do something around that, around this arena of dental real estate. So the best part is we as dentists, we go in there, we go in a space, even if it's a space that has not been previously occupied, the minute we go in there, that valuation automatically goes up. Why is that? Number one, couple of reasons. Healthcare professionals, anytime a healthcare goes in an office building or maybe even a strip plaza, that valuation is going up because we are long-term tenants. That's number one. We as dentists, we invest quite a bit in making a space into a dental office because there's a lot of investment that goes into play as well as the equipment that goes into play. So landlord loves us, right? So if they love us, the thing is most of you guys already own real estate of your own practices. But for somebody who is actually like on the fence or maybe wanting to start a practice, this is one perk that we would like to discuss, and you do not want to miss this one. Own the real estate if you can. So, Tom, we talk about real estate, we talk about cap rates, we talk about rent appreciation. Um, what are some of those things that we are looking at in terms of tenants and rents? Because we always talk about like we need more doors, right? Let's
Right.
dive a little bit into the strip mall because there are a lot of experts on this subject with the triple net. But what are your thoughts and what have we discussed in the past? Like some of your input.
Yeah. So here we are talking about when you're running your dental practice, you have a couple of options, right? You can either go and rent a place in a strip mall, or you can buy a property and you could be the tenant or one of the tenants, right? So yeah, that's the option we are talking about here. Let's talk about why it's beneficial for you to own the building that you practice in, like Dr. Noah Liu was saying.
Hmm.
The reason is you are going to be the tenant. Like, one of the things when you buy a building or any real estate is the assurance that it's going to be occupied, right? So because the value of the building is going to be based on whether it's occupied or not. Now, if you're going to occupy the building, you know that that part of the equation is already solved. If it's a multi-tenant building and you are one of the three tenants, it's 33% occupied the moment you move in.
Hmm.
You only have to fill up another 66%, right? So that's why you should be owning the place. If you have any interest in owning real estate, this is one of the best ways to do it if you're the tenant yourself. Now, he's also talking about where people want to invest in other dental office buildings. Is that right?
That's
Is that
that's
what?
right. That's right. And this is like the best secret that a lot of people keep it to themselves. If you are looking to get into real estate and you're a dentist, the first thing to do is invest in your own office.
Hmm.
And that's like the one advice that I got too late in my career. But again, It's never too late. We can always start somewhere.
Right. And one of the things also, I think if anybody is looking into that and if they're thinking about that and you've never done it before, is how do you do it? You don't want to keep it as part of your practice. You want to start another LLC, and that LLC
Love it.
should be owning that building. And your dental practice LLC will be paying rent to the other LLC that owns the building. So that way, let's say down the line, you want to sell your practice, it doesn't show, it shows a massive amount of profit compared to, paying the mortgage and stuff like that. So you want to keep it a separate LLC. Is that right? Is that one of the best advices that you've heard before? I'm sure everybody knows this, but for those who don't,
Man,
like.
let's dive deep. Let's dive deep in this, because
Mm,
this is one of those areas a lot of people make mistakes in. So it's got to be
mm,
under a different LLC. A lot of people that will actually get this part right. They'll have a different LLC. They'll have a different LLC for the business, a different LLC for the real estate. But where
mhm,
a lot of people they start getting into a little bit of turmoil is when they are going to go out there to the banks and the bank is going to loan them money.
mhm,
So
okay.
the problem that we've always seen is the banks want to put everything under collateral. They'll take
Mm,
your real estate, they'll take your practice, they'll put it all under one umbrella. Even though you have two different LLCs, doesn't matter for the bank.
mm,
So here's how you do the system. You want to make sure, now again, this is not a tax advice, this is not a legal advice. This is how we did it, and this is what I'm telling you what I did. So if I'm telling you something, you need to verify.
right.
How
Mm,
I did was you take your LLC, you have a separate LLC for your business, you have a separate LLC for your real estate. Now, your real estate LLC is owned by another LLC. So, wherever that state is, you have your practice in. So, let's say, for example, Illinois. So, the
mhm,
Illinois LLC is going to be owning the real estate, and the Illinois LLC that is owning the real estate. Another LLC is owning that LLC, that Illinois LLC. What that does, it keeps everything anonymous. Now we are aware of the CTA, the Corporate Transparency Act that's in play. That may not really matter. A lot of them
but
for
by the way, let me talk about that corporate
yeah. Let's
transparency.
let's do it. Shoot.
Yeah.
We opening up a bunch of can of worms
Yeah,
here, man.
everybody was upset about it. Everybody was panicked about it. Thank God that that got stayed by the court. It got appealed, but again, the court put a stay. So they said you don't have to file it until there is clarity on this matter. So
Didn't they put it back that it's that we
no,
have
they
to
put
file?
they stayed. They put it back, but it went back again at the
Really?
11th hour. So thank God I didn't have to do it. I mean, I was just debating if I should get my accountant to do it, but then you got to give all the details of every LLC. Not that we have anything to hide, but we don't want to tell everybody everything. You know what I'm saying?
Exactly.
So,
And that's the whole
so I
reason,
hope
right? Yeah.
the new administration strikes that law down, which is a stupid law. It should be thrown out, is what I'm thinking. Though, anyway, back to the
Precisely.
topic. Yeah. So
Precisely.
your real estate LLC is owned by another LLC. Is that going to be in another state then, like Wyoming or something?
There you go. Right. You nailed it right on the spot. Wyoming, Delaware, anywhere where they have anonymity, right? So
Mm,
we want to make sure, like, hey, that LLC is protected by another LLC. Now, that's
mm,
number one. Step number two is you want to make sure when we are talking to banks, we have a separate lender for the real estate, a different, totally different lender. And
mm,
then for the practice, it's a totally different lender. That's where many of our colleagues they mix them together, and that's where the banks get them. If
mm,
you think about it, if you can think about like a practice and you want to get your practice, let's say, for example, in the future, we are selling the practice, we can still hold on to that LLC that owns the real estate. So
mhm,
that's the key that, you want to start thinking. And for guys out there, the entrepreneur guys who are owning like multiple practices, like two or three practices, if you are going to be owning the real estate, again, you want to do the same gameplay and keep everything real
and
estate
that.
separate.
So does that Wyoming LLC own the other LLCs that own different practices too?
We could put under a holding company, right? And we all know
Yeah.
how this works. Put under a holding company, now the holding company can go straight under a trust. Now it's
Mhm.
like totally like protected. So you got a layer over layer over layer.
Yeah.
The downside is accounting. You and
Yeah.
I, we both know the downside is coming down and filing all those accountings, right?
Yeah.
but it's a good way to structure it so that, in the event, if there's ever a malpractice lawsuit or something along those lines where we go over our coverage,
Mm.
it's going to be hard to peel off all these different layers that we have in place.
Absolutely, man. You got to protect yourself. People don't understand this about you don't want to put your name on who owns the building and all this stuff all over the place because there are people out there who's after you, and if something happens, you want to stay as
Hmm.
anonymous as possible so that nobody knows what is going on. But I have a question about so the when you go to the banks, and the banks is the LLC that owns the property, right?
Hmm.
The dental building, and so now that the Wyoming LLC owns the bank, that LLC. So is the bank going to ask you to give you the Wyoming LLC docs or anything like that?
Correct. Correct. Now it's a different lender. So we want to
Okay.
make sure it's a different lender. It's not the same lenders. And we always want to make sure like they're going to have some sort of a guarantee, like a office guarantee or maybe like a corporate guarantee, but it won't be collateralized. It's not going to have like a lien on the business
Oh,
or the
really?
property.
That's
Yes.
because there's a separate loan on that building from a different
Separate
bank. That's
separate
why.
loan. Correct.
Got it.
Correct.
Okay.
For the banks, for the banks who is actually going to be lending money on the property, on the real estate, they are just going to probably ask for a guarantee from the
Hmm.
business that, hey, if this thing ever goes out, your business can carry the load. That's a
Hmm.
different story than having a lien put on the property and saying like, hey, this is collateralized with your business. Totally separate scenario.
Right. Cool.
So,
Awesome.
so Tom, let's dive into one of those aspects where you see a property, you see a dental office, or you want to open up a dental office. It doesn't really matter, right? I mean,
Mhm.
let's talk about an investment property, something that um, Sanjay brought up the other day. Let's talk about the due diligence aspect. We see a property, we identify, we have a good target. This place is trading for, let's say, $1 million, for example. The dentist is in there, they've been there for X amount of time. One of those things that we always want to look for is the lease, right? We want to look
Mhm.
at how many more years are left in the lease. What are the renewal options like? And some of those things where we also want to see is what is the dentist financial status like, because we want to see the financials for the business. Because if
Mhm.
there's no dentist and there is no NOI, then there's no real estate,
Correct.
right? So let's say you identify a business, you identify a dental office. What are some of the things that you are going to be looking for?
Yep.
I was saying it's pretty much like how we do any other real estate, right?
Any
But
other
I,
deal,
I
right?
want to hear it from you. Like, what will you look for?
Yeah. The first thing I would look for is a location, right? I think
Oh,
everybody
love it,
knows that.
love
Yeah,
it.
you got to have it in a great location. I mean, great location can almost weather any storm. It could be recession. It could be any kind of downturn can be weathered almost by a great location. The second thing, once you know it's in a great location, a great spot, a growing spot, you want to look at the vacancy, like how many units are occupied, right? If
Mm,
it's 50% empty, I don't know. I don't want to take that risk. They will give you all kinds of rosy pictures saying, hey, man, you can rehab it, you can rent it out. All that stuff then quickly becomes a second job. We want to go into cash flow producing properties unless you are going to be a tenant there and fill
exactly.
up the 50%. I would not be interested too much in that. I mean, so vacancy. So if it's occupied at at more than 90%, I think it's a good one. Then obviously you want to look at the lease and
Hmm.
see take a look at the leases and see what income is coming in every month. Do the math, income minus expense, and then look at the NOI. Okay, so once you have the NOI, we have talked about how to do the calculation on how to find the value of the building. So you get the NOI, then look at the leases and see if these guys are in pretty good shape. Like if the guy is 70 years old and he's going to retire, then it may not be a good situation, right? So you want to look at the leases and then look at their business information. If it's a dentist, almost all the time they have to provide their tax returns to the landlord, the previous landlord, or the
Right.
landlord that is selling. You can analyze all that. Just so basically, at the end of the day, you want to make sure they're solid tenants. So get the NOI, make sure they're solid tenants, and what else? What else would you say?
You know, that's huge. And of course, we also want to see if there's been any kind of title problems or lien problems or any kind of
Mm,
legal problems or any kind of tax problems with the tenant.
right.
So, so those are some of those things. So, three things we always look for: EPA, survey, and title.
Hmm.
Always want to keep in mind any kind of real estate. Those three always apply. If one of them is a red flag, it's a dead deal.
Yep.
Um, so one last thing we want to touch base on before we land the plane is when we look at these dental offices and the real estate that we're looking at, and if let's say we are going to be the tenants in there, many people are already doing this. They actually jack up the rent for themselves, right?
Hmm.
With that being said, it's a strong recommendation to do a cost segregation study so that we can maximize the depreciation on paper. And provided that we are going to be long-term tenants, which we are going to be long-term tenants, that can sort of avoid some sort of the recapture if we ever to sell it. But in our case, if we're going to be long-term tenants for a long time, I don't think that's a problem, right, Tom?
Yeah, absolutely. Yeah, you don't need to worry about that. You're right.
The recapture part.
Yeah.
However, with that being said, what I always like to say is if we're going to pay ourselves rent, the best way to do a forced appreciation on the dental office building is a higher rent with a good lease, which is about at least 3.5 to 4% escalations every year, year after year after year, and start doing it in such a way that whatever loan amount we got for the practice, we can somehow cash out in the next 6 to 7 years.
Mm-hmm.
And that's the key by doing a refi after the valuation has gone up with a good track record of rents that's going into the LLC, which owns the
Man,
property.
that's a golden nugget right there. What you said about it's cashing out.
Right.
Yeah, cashing out using the refi and based on the valuation of the bit, and then almost you get the whatever loan you took can be paid off with that.
Can
Is
be
what you
paid
said,
off.
right?
Pay off loan number one, take
Yeah.
the extra, but do not over leverage. You might just want to think about refining 65% to be on the safe
Hmm.
side and still leaving about 35% equity in the business. And then from there, get out, pay off, and then whatever cash is left over, it's yours to keep, or you can put it back into another investment
Yeah.
and tax free.
Awesome. Great, great, man. These were some great tips, amazing tips. And if you want to know more about this, basically, I know that there is more details that we probably left out. Just definitely
A
reach
lot,
out
a
to, yeah,
lot.
yeah, reach out to Noel. He's done a lot of this. You can DM us, message us, on Facebook. And if you have any questions, just leave it in the comments. It'll benefit the other people too. And we'd love to answer those questions. So, with that being said, we're going to land the plane. Any other last thoughts?
Nope, that's it.
All right, everybody.
All
Have a
righty.
good evening. Bye bye.
Yep. Take care and have a good weekend.
We'll see you next
All
week.
right. Next week.
Bye.
Bye.